If you were watching the markets in early February 2026, you saw something absolutely wild. The precious metals market went from a massive, historic rally to a complete and total rout, wiping out trillions in value in just a matter of days. So what on earth just happened? Let's get into it.
Just look at this number, negative 41.1%. That's how much the price of silver plummeted from its all-time high of over $121 an ounce in just a few days. It was an absolutely brutal, breathtaking sell-off that caught pretty much everyone off guard. And look, this wasn't just new investors getting spooked. We're talking about seasoned veterans being completely stunned. Bruce Gamizu, who runs the Japan Bullion Market Association, said he's watched this market for 40 years and it never seen anything like it. He called the volatility unprecedented. That tells you this was no ordinary dip.
So what really went down? Well, it wasn't just one thing. It was a perfect storm, where a bunch of incredibly powerful forces all slammed together at the exact same time. We're going to break down the three key elements for you: the spark that lit the fire, the fuel that made it explode, and the really weird aftermath.
All right, so first up, the spark. Every fire starts with one, right? And for the market, this initial flash of lightning came from a huge policy announcement straight out of Washington. And here it is. The trigger was the news that President Trump planned to nominate Kevin Warsh as the next chairman of the Federal Reserve. You might think, okay, a new Fed chair, what's the big deal? But this single piece of news was the catalyst that sent massive shockwaves through the entire commodities world.
So why was this one name so important? It's because Kevin Warsh is what's known in financial circles as a monetary hawk. A hawk is someone who is really tough on inflation. They're the type to favor higher interest rates to keep prices down. And for the markets, that was a huge signal that the whole era of easy money could be coming to a screeching halt.
And that news set off an immediate chain reaction, like a line of dominoes. First, the idea of a hawkish Fed made the US dollar soar. Now, since gold and silver are priced in dollars, a stronger dollar automatically pushes their prices down. And that initial drop was all it took to trigger a massive wave of automated sell orders from high-frequency trading algorithms. The machines just took over.
So that nomination was the spark, for sure. But the market itself, it was like a tinderbox, just soaked in gasoline, waiting for a match. And that brings us to the second and maybe most important element of this perfect storm.
You see, the market was just dangerously overheated. It had become what they call a crowded trade, where basically everyone was betting on prices to keep going up. You had a fear premium from global tensions, and then a flood of speculative hot money, a lot of it coming from China, that pushed prices to just insane parabolic levels. The price on the screen was completely disconnected from the actual physical supply and demand on the ground.
Now, to really understand the mechanics of how this thing unraveled so fast, we gotta talk about something called a margin requirement. The easiest way to think about it is like a security deposit. When you trade with borrowed money, which is called leverage, you have to put down a cash deposit. But here's the kicker. When things get crazy and volatile, the exchanges can suddenly demand a way bigger deposit. And this is what created a catastrophic death spiral, a liquidation loop. The first price drop caused the big exchanges to hike their margin requirements. So all these speculators who were leveraged to the hilt were suddenly forced to either come up with huge amounts of cash on the spot or sell their positions immediately. That forced selling, of course, pushed prices even lower, which triggered even more margin calls for other traders. It was a vicious, self-feeding downward spiral.
Okay, so let's talk about the bizarre aftermath. Once the dust from that liquidation storm finally settled, a really fascinating paradox emerged, especially when you look at the silver market. And honestly, this is where the story gets really, really interesting.
Check out this split. It's like you're looking at two completely different worlds. The paper market, things like ETFs and futures contracts, was in a state of absolute panic, forced liquidations everywhere. But the physical market, for actual silver bars and coins, that told a totally different story. Premiums to get your hands on physical metal actually went up as investors started buying the dip, showing they still believed in silver's long-term value. And here's the smoking gun that proves just how high physical demand was. The market went into a rare state called backwardation. All that means is that it was more expensive to get silver for delivery right now than it was to get it delivered sometime in the future. That is a classic textbook sign of real-world scarcity, even as the paper price was absolutely cratering.
So this huge disconnect leads us to a much more provocative question that a lot of analysts started asking. Was this just a natural, healthy correction that flushed out all the speculators, or was there something else going on here? Was this, as one analyst described it, a brutal rescue operation?
Now here's the evidence for that theory. It turns out that major banks, with JP Morgan leading the pack, were holding enormous short positions. Basically, they were betting that silver's price would fall. When silver hit its peak, they were looking at over $10 billion in paper losses. That's enough to threaten the stability of the entire exchange. Then, almost like magic, JP Morgan managed to close out $10 billion of those shorts at precisely $78.29, the absolute rock-bottom price of the entire crash. The timing was suspicious, to say the least.
So after all that chaos, after that absolute bloodbath, where do we go from here? Let's take a look at what the big financial institutions are thinking now that this great deleveraging event seems to be over.
Believe it or not, despite the insane volatility, the institutional outlook is still firmly bullish. Why? Because the core reasons that drove the rally in the first place, they haven't gone anywhere. Central banks around the world are still buying up massive amounts of gold to get away from the dollar, and investors globally are continuing to shift into real, tangible assets.
And you can see that confidence right here in their year-end price targets for gold. JP Morgan is calling for $6,300, UBS is right there at $6,200, and you've got Deutsche Bank and SocGen both seeing gold hit $6,000. These are seriously bullish numbers.
And the long-term case for silver is also considered really strong. For the sixth straight year, the world is facing a structural supply deficit. The demand from industry for things like solar panels, electric vehicles, and AI hardware is just outstripping what miners can pull out of the ground. Because of that fundamental imbalance, some forecasts see silver climbing back up to between $120 and $133 an ounce by late 2026.
Okay, let's wrap this all up. This wasn't a simple crash. As we said at the beginning, it was a perfect storm, created when three powerful and distinct forces all converged at once. So, to quickly recap the main drivers, you had the policy spark, which was that hawkish Fed nomination changing the game on interest rates. You had the leverage fuel, a market just begging for a flush out of all the speculative money. And finally, a bit of geopolitical calm, as some of those global tensions, particularly around Greenland and Iran, started to ease. That fear premium that had been propping up prices started to just evaporate.
Which leaves us with the big final question. All that speculative froth has been violently wiped out. The so-called weak hands have been completely forced out of the market. So, has this historic deleveraging event essentially cleared the decks and reset the board for a more fundamentally driven and maybe more sustainable rally to begin?
And just before we signed off, a quick and important reminder. This content is for informational purposes only, and it absolutely does not constitute financial advice. Thanks so much for tuning in.